So gold's up 7% in 3 days and I haven't bought a single ounce, which probably sounds crazy coming from me of all people, but, and I'm sorry to be the one to tell you this, but 96% of the time a move like this happens, it's a trap. Just not the trap you're probably thinking of. So if you already hold gold, silver, or even if you're planning to buy them for the first time, this video is for you, because today we'll be talking about a few things. First, we've all watched gold and silver bleed for 6 months. Now there's finally some green on the screen, so we need to answer the big question: will it last? Spoiler alert, a move like this fails 96% of the time. I already said that though. So we need to talk about whether this time is different. It could be, you never know. And finally, what I'm doing with my own gold and silver. So let's figure this out together. Right, so all of July, gold did absolutely nothing. It sat between about 4,000 and 4,100 for a solid month and bored everyone to death. Same story every morning, you open your chart, nothing's moved, you close your chart. Then all of a sudden, last week, it just wakes up. On Wednesday, gold rallied 4% in a single day. Actually, it was a bit more than 4%. Next day, Thursday, it did absolutely nothing, boring again. And then comes Friday, where it added another 2.4%. And I think it went as high as 3.2%. So from Wednesday's open to Friday's high, that's 7.2% on gold in 3 days. After a month of flat, right? Remember those 3 days though, because they are important. We're going to talk a lot about these big spikes that happen over a few days and what they mean. Anyway, also silver came along for the ride and it's sat at around $63 now. And as usual, investors lost their mind. Bottoms in, here we go. My email inbox on Friday was absolutely unreal. Really lovely people. I love your emails, don't get me wrong. But they were all asking me the same version of the same question. Should I buy now? Have I left it too late? Is it going to run away from me? And I know exactly how that feels because I felt that in 2011 when I first wanted to buy silver. But I didn't buy, and I never regretted that decision because it meant the difference between silver at $50 and silver at $20. Now, let me be really clear about this though, because that's not what I'm saying here. Because there's always some guy called Chad in the comments who hears everything in black and white. And what Chad is going to say is, Nick says, do not buy gold. It's definitely going back to 4K or lower. Or don't buy silver because it'll go back to $20. That's not what I'm saying. There's a lot of layers to this and I'm going to go through them one by one in this video. Personally, I probably won't buy any more gold unless it gets below $4,000, but I'm not selling any either. I've got 30% of my portfolio metals already, so trust me when I say I'm very, very bullish on metals. My friends call me Magneto for a reason. So no, I'm not saying don't buy gold. If you want to buy some, go and get some. Never let some knob on YouTube tell you not to buy gold if you want to. What I'm saying is you might not want to buy it all at once just because it pumped for 3 days. And I say that because 96% of the time a move like this happens, it's a trap. 96%, I've said that a bunch of times, and it's a very specific number. Where am I pulling that number from? Well, it's all data. And I have the data. I went and counted every single time gold pumped at least 7% in a short period since 1975. So every time it pumped at least 7% in 3 days. I found 26 instances. I'm perfectly aware of how sad that sounds, but yeah, I actually did that. And then I went back and I looked for some even more important data, which we'll talk about soon. So I was specifically looking for these quick, sharp price spikes over a short period of time, like we saw Wednesday through to Thursday of last week. And I don't want you to take my word for it. I published this data for you on my new free community. I launched a community called Owners Club for, owners of gold and silver. It's an old school forum style community. There's a link to it below. Join now, it's free, and you get to talk with me and other people who are interested in gold and silver. It's a fun community, but it just launched, so there's not many people in there yet. But yeah, anyway, the data is published there, so go check it out. Now, let's talk about the data. Like I said, I pulled every single daily gold price going back to 1975, just over 13,000 trading days, 51 years of it. Then I went looking for every time gold went up 7% or more in 3 days. Same sort of move that we just had. There are 26 of them. And I asked one question of every single one. After that spike, did you ever get the same price or cheaper again in the next 6 months? Because this would tell me if on average, these moves retrace. Right? If they retrace quickly, really. Gold said yes, 25 out of 26 times. Actually, gold didn't say that. The little program I built to pass the data said that. So 25 out of 26 times is 96%. So what this means is that 25 out of 26 times that gold spiked up this quickly in such a short period of time, it retraced within 6 months. Usually within a few weeks, by the way. So it doesn't even usually take 6 months. The typical retrace wasn't small either. On average, after a move like this, you could buy about 8% cheaper within the next 6 months. Now, I can already hear what some of you are thinking. Nick, 26 96 times, that's a very small sample size. And you know what? You are completely right. It is a small sample size. So let me widen it a bit. Let's drop the bar to 5% moves instead of 7% moves. Gold is not really crazy volatile, so 5% in a few days is pretty significant for gold. It happens on average 1.2 times per year. So over 51 years, that gives us about 62 data points. And I asked the same question: did you ever get the same price or cheaper again in the next 6 months after pumping that much? The program said yes. 59 out of 62 retraced within 6 months, most within a few weeks, which is again around 95%, but let's just round it up to 96% because it sounds better. I don't know why I said that. 95%. So this means through every kind of market there is, bull runs, crashes, high inflation, low inflation, it doesn't really matter what kind of market. For the last 51 years, when gold spikes 5% in a few days, it retraces within 6 months. And most of the time, it doesn't even take 6 months. Half of them retrace to a better price inside of one bloody week. But there's more. Trust me, this gets a whole lot better. We're not going to stop here. Now, I said 59 out of 62 times, which leaves 3 times that gold never came back to the price. Surely those 3 times would have cost you if you didn't FOMO buy. Not really. The worst of the 3, all you would have had to pay more is 1.5%. One of them was only 0.07%, so it came back down within 1.5%. So think about what that actually means. That's like going, oh no, I didn't FOMO into gold at $1,000 and now I have to pay $1,015 instead. My life is ruined. By the way, if you don't know what FOMO is, it's fear of missing out. It's when you rush into a position out of fear of missing out. So anyway, even if you didn't rush in, the worst case, it would have cost you 1.5% more to buy back on the dip. But let's look at a few actual examples of this in action, really. I'll pick recent ones. You don't need to go back 51 years for this. Gold has done this twice already in 2026. We'll start with late March, the 27th through to the 31st. Gold went from 4,390 up to 4,690, just under 7% in 3 days. And everyone was certain the bottom was in and gold would shoot up to 10K in the next week. That's what everyone was saying. I mean, they weren't really saying 10K, but they were saying that the bottom was in and it was going to make a new all-time high. And to be fair, for a little while, it did keep going. It carried on climbing all the way up to nearly 4,900 by the middle of April. So if you rushed in at the end of March, you felt like an absolute genius for about 3 weeks. And then it all dumped. It dumped to 3,940 by the end of June. That's 19% off of the April high. So what was the trap there? Simple. People saw the price fly up. They thought, I have to get in because this is going back up. And a few weeks later, it crashed. Another example was June 11th through to June 15th. Gold went from 4,061 up to 4,370. That's 7.6% in 3 days. Very similar to this current move. Then gold topped and it dumped down to 4,000 in 9 days. And look, I'm not saying that just because it did at that time that gold is going to go back to 4,000 because that's what it did in June. That would be stupid. I don't know what happens next. Nobody does. The point is a bit smaller than that, but it's a lot more useful. Every single one of these instances felt urgent at the time, but not one of them had to be bought that week. So that urgency you feel, that's the trap. It's a well-known one called FOMO. So when you see a move like this, your reaction shouldn't be, right, I'm putting everything in I can. It should just be to step back, breathe and go, okay, do I actually want to own gold at this price? And if the answer is yes, buy some. Don't buy loads, buy some, then wait. Because 96% of the time, you're going to get an opportunity to buy it cheaper. And the 4% that it wasn't cheaper, it was only marginally more expensive. Remember the example I gave you? Worst case scenario, you'd be paying $1,015 versus $1,000. But look, this is a lesson that every investor learns the hard way. Me, honestly, I only really learned it because I had good people around me. It took me about 10 years of investing before I properly accepted it. It took me a long time to learn this, way too long. And I can tell you the exact moment it happened because it was actually with silver back in 2011. So I'd been an investor for a decade by then, so I wasn't new by any means. And back then, silver went on a run that looked a lot like this one. And I wanted in. I mean, I really, really wanted in silver. And a bunch of older guys, my mentors really, they started telling me the same thing over and over. Don't FOMO. This exact same thing happened in the 80s to us, and every single person who chased it got hurt. And I listened to them. I mean, I had 10 years of FOMO under my belt, so I'd felt the sting many times. Then finally, the older, wiser people got through to me. It takes a lot to get through to me. I'm very stubborn. Anyway, it was horrible at first. I sat there and I watched it keep going up without me for weeks. Every day it went up was another day I felt like an idiot for listening to them. That's the bit that nobody really tells you about patience, by the way. Patience is the most important skill for an investor to have. But the bit that nobody tells you is it doesn't feel clever at the time. It feels like you're missing it right up until the moment that you're not missing it. Because then silver crashed and it kept crashing. So eventually I started buying in 2013 and I bought most of my silver over the next 7 years from there. So my average buy on silver ended up being $22. So I could have bought at $50 in 2011 and then sat there underwater for 14 years because that's how long it took for silver to get back to $50. 14 years of being wrong. Instead, I learned that patience pays, and it paid me a lot. And when I say it paid me a lot, what I mean is I like gold and silver. I want to own a lot of it. I want to own as much of it as I possibly can. So the cheaper that I can buy it, the more of it I hold. So that's the goal for me. I'm always looking to buy it cheap. And before Chad turns up in the comments going, oh my God, silver isn't going back to $20. That's not what I'm saying, Chad. I'm not saying that silver is going back to $20. I doubt it would be. I'm saying that rushing in because of FOMO is almost always the wrong decision. For the record, I think gold and silver are going to be a lot higher than they are now over the next decade. Honestly, probably even in the next few years. That's exactly why 30% of my portfolio is in metals. So I'm not arguing don't buy or that it will go down for sure. I'm arguing that you shouldn't blindly jump in just because it went up for 3 days. I'm arguing for patience because in this game, the turtle always beats the hare. Anyway, whatever, enough philosophy, right? There's another question that I'm sure a lot of you would be asking right now. Is this time different? We need to talk about that because every single one of those spikes had a story attached to it at the time. So what's the story behind this spike? And if it's something big, something structural, then fair enough. Then it's going to keep going. Maybe this one is the one that runs and doesn't come back. So let's actually look at it. What caused this move? So gold didn't move because of China. It didn't move because of a reset. Nothing structural really happened this week at all. Two things happened on 2 different days. First was Wednesday. Gold rallied 4% because of Iran. Iranian officials signaled that they were close to a deal with Oman to reopen the Strait of Hormuz. Now, if you're not a massive nerd that stares at shipping maps all day, the Strait of Hormuz is a narrow bit of water at the mouth of the Gulf, and an enormous share of the world's oil gets shipped through it. Shut it, and oil prices go mad. Reopen it, and oil prices come down. So follow that through. Oil falls, cheaper oil means that inflation, the inflation that everyone's panicking about, starts looking less bad. And inflation looks less bad means that the Fed is under less pressure to put interest rates up. In fact, it means that they're more likely to cut interest rates, and interest rate cuts are good for gold. Simple. So that's what pushed price up on Wednesday. Then Friday came and it brought the American jobs report. The number came in at minus 23,000 for the non-farm payroll figures, which is basically a monthly count of how many jobs the American economy added or lost, not counting farm work because farm work is seasonal. So minus 23,000 means that they didn't add any. They lost 23,000 jobs in the US. And job creation in the US has been on a downward slide for months now. In March, America added 214,000 jobs. By June, it was down to 20,000. In July, it went backwards, minus 23,000, like I said. Now, the strange part is that the unemployment rate actually went down from 4.2% to 4.1%. So get this, jobs were lost and unemployment rate went down. I mean, that kind of sounds like good news, but it really isn't. And it only really makes sense when you understand how manipulated these figures are. But that's a whole other video though. The point to take home is that the labor market in the US is not looking too good right now. And you should care about that wherever in the world you live, because American job numbers affect American interest rates, and interest rates are what move the price of gold that's sat in your account or in your vault, hopefully, because hopefully you hold physical gold and not an ETF. Anyway, the biggest problem is that while nobody's being fired, nobody's really being hired in the US either. So it's just kind of flat. This is if you believe any of those official numbers, but either way, the market reacts like it believes them. So that's what really matters for now. And that puts the Fed into a massive corner. Inflation is running at 3.5% and their target is 2%. When inflation is too high, you raise interest rates to cool things down because more expensive expensive borrowing means people spend less money. So on that side, they want rates higher. But when jobs are disappearing, you do the opposite. You cut rates to make borrowing cheap so businesses hire and spend. So the inflation numbers right now say that rates should rise. The labor market says that they should cut rates. If they raise, they make the labor market worse. If they cut, they make inflation worse. It's not a great spot to be in if you're the Fed. And this means a week ago, traders were pricing in roughly a 65% chance of a rate rise in September. After Friday, it's nearer to 50%. So the odds that rates are going to rise has dropped significantly, which is why gold added another 2.4% to its price on Friday. So there's your answer. This whole move is standing on a peace deal that hasn't been signed yet and 1 month of jobs numbers. Both of those can turn around on a single headline. There's another jobs report in early September, a few days before the Fed's next meeting on the 16th. If the labor market shows a bit of strength again, that rate rise is back on the table. And look, once again, I'm not saying that for sure we're going back below 4,000 on gold. That is not the point I'm making. I'm just saying that this move isn't based on anything structural changing with gold and silver. It's based on headlines for now. And those moves, those are the ones that are most susceptible to a retrace. In other words, this time looks roughly about the same as the other 26 times this has happened since 1971. But look, even if this time was different, there's only one calculation that really matters here. And it's the cost of patience. So let's calculate that. Let's calculate the cost of patience. One of my favorite things to do in investing. If you buy a little now and you wait to buy more, historically, like I said, and you're tired of me saying this, there's a 96% chance it will retrace and be 8% cheaper within 6 months, usually quicker. So on $10,000, that's roughly $800 that you get to keep. And if you wait and you're wrong, gold just runs and never comes back. Well, we did the maths already. Worst case, in 51 years, it cost about 1.5% to buy back in. Now, I'm not saying sit in cash forever, waiting for some perfect price that never shows up. That is its own kind of stupid, and I've watched people do that for years while things tripled. So how do you actually work out what to do with a week like this? Because don't FOMO is easy for someone to say on YouTube, but it isn't the same as do not buy. There isn't one right answer here though. There can't be, because it depends on you. It depends on you as an individual. For me, it comes down to two things. How long until you retire and what you already own. Those are the two things. Start with how long until you retire. If you're 25 and you're not touching this money or this gold for another 35 years, then the difference between buying gold at 4,300 and buying it at 3,800 is almost just noise. It feels enormous today, but spread that over 35 years, it's a rounding error on your average price, because you're not making one purchase, you're making 100 of them over decades, and they average out. The price you pay this Tuesday is one dot on a line with very, very, very many dots. So if that's you and you own no gold at all, then buying some here is fine. Go for it. You're not timing anything. You're just starting out. Buy some bloody gold. Not financial advice. But same if you're 45, by the way, or 50 with no gold or silver. If you want some, by all means, buy some now. You're building a position, you're not trying to catch the bottom. But now let's flip it around. Say you're 55 and you're a few years away from retiring. Congrats, good for you. I'm very happy for you. And you've already got a decent pile of metal just sat there. Everything changes. Not because gold is any different, but because you're different. You're in a different position to the other guy. You've already got the exposure, so there's no rush to buy anymore. And the thing you can't afford at this point in your life is a position that's down a lot, because you haven't got decades to sit and wait for it to come back. That's where FOMO stops being a rounding error and starts being properly expensive. And I know what you're going to say, yeah, but how's that going to change if I FOMO in now, then it dips 8%? But it's not just about now, it's about having the habit of FOMOing, because that's going to cost you over the long run. I mean, look at silver in January. It traded above $112 for a few days at the end of the month. Everyone was very excited about it. If you polled in there, you'd be down 43% today. So if you're 30, that's annoying, but it's fine, because you've got 35 years or 25 years for that to sort itself out, and it probably will. If you're 57 and that was a serious chunk of your retirement, that's a completely different story. That's the sort of hole that could push your retirement back a year or two, or maybe even 3 if you invested enough. So you've got the same investment, the same price, but it means completely different things because of the person who did the buying. And look, I'm not going to sit here and run through every combination. If you're 45 with 10% in gold, do this. If you're 38 with 5%, do that. We'd be here all day and I'll probably miss your exact situation anyway. The point is this: Don't FOMO. It's a trap. Look at your situation and decide if it makes sense for you to buy now, or if you're like me and you would prefer a cheaper price. So before you do anything this week, go and work out those two things. How long until you actually need this money? How long until you retire? And how much of what you already own is sat in metals? Then the question stops being, is gold going up? And it turns into, does buying more of it today at this price actually change anything for me? For a lot of you, the answer to that is just going to be a flat no, and that makes this next week a whole lot easier. But I'll show you one example in action of what I'm doing, right? So about 30% of everything I own is in metals. I've repeated myself so many times in this video. My average gold buy is about $1,400. I'm doing that from memory. It might be a bit less, a bit more. I'll buy more if it goes below 4,000. And if it doesn't get there, I'm not bothered at the moment. I just don't really care. I hold enough. And look, I don't say the next thing I'm about to say to brag. I say it because it proves my overall point with this video. That 30% that I've got sat in metals is enough to fund my retirement 2.6 times over. Right, so if I look at all the money I'm going to need for retirement, just the metals alone, 2.6 times easily, right? And I only got there by being patient, by not FOMOing throughout most of my career for the last 15 years. Like I said, I learned that lesson about 15 years ago. And that's one of the most important lessons I learned in this game. It's patience. It's not exactly complicated, is it? But if you aren't there yet, how do you get there? How do you get into that position where you have enough to retire? By being smart about when you buy. For most people, buying in bits and pieces is the easiest play. If you want to buy now, do it. But make sure that you have money set aside to buy more if price comes back down, because the data shows it usually does 96% of the time. Sorry for saying again. Also, write down the prices that you want to buy gold at. My prices, for example, are 3.9K, 3.7K, 3.5K, and I will deploy serious capital if we get lucky enough and it goes below 3.5K. If we don't, then I don't really care. There are other assets I want to buy, like copper, that I think could outperform gold for some periods in the next decade. Just my opinion though, not financial advice. Because when I ask myself the question, how long until I retire? I mean, technically I retired 5 years ago, but then I kind of got bored and I started working again. But anyway, when I ask myself technically, how long until I retire? Retirement is probably about 5 years away for me. Although my wife says that I'm never going to retire, and she's probably right. But anyway, regardless, let's say it's about 5 years from now. Do I hold enough gold and silver? Yeah, of course I do. I already said I do. Could I buy more? Yeah, if the price is right. Do I own enough copper? No, I don't. Could I buy more? Yeah. When there's a big enough dip, I will be buying more, because I'm pretty confident that over the next 5 years, if I average in at around $5.50 on copper, I'll be in a good position. So let's summarize what's really going on here with gold. Why am I talking about copper now? A peace rumor and weak job numbers shifted what people think the Fed does next, and gold moved 7% because of it. It could keep running, it might retrace. Historically speaking, 96%, blah, blah, blah. The trap is deciding on the third green day in a row that you need to go all in on gold, and you need to own it all before Monday. The key here is do not FOMO. Take a step back, assess the situation, and see if it makes sense to buy now, or if you're just rushing in and are going to get trapped. And remember, the page with all the data is linked to below. It's free. There's nothing to buy. So go join the community and then you'll get access to that page. I launched a community recently. I'll be posting there daily from this week. So I'll see you in the next one.